Hello everyone, this is Jim Hiles from First Capital and Go Plan 101. And today I'm going to wax on and wax off a little bit. So bear with me because I'm going to answer the question of what's up with the allocation, where are you putting money, where have you put money, how's it worked out, and what do you think going forward? So a lot going on here to help specifically on allocation of assets. Before I get into that, just before I forget here, we are posting to a great number of social media sites out there. You'll see us on Facebook, LinkedIn, Twitter, Instagram, and YouTube. We have our own YouTube channel, so take a look at that. Okay, let's get right into the allocation scoreboard here. Risk on or risk off, wax on or wax off. We are in a risk on state. In other words, we are still looking at risky asset investments being preferred over non-risk investments. Main reason, Fed stimulus. Don't fight the Fed. Too much money is coming into the market. We're getting great support that. Plus, we're still having this optimism and sentiment. The way people think about the future is going to be better than it has been. And it just seems that all you have to do is get less bad news and the market goes up. And that's kind of what has happened. And by the way, we expect that to continue to happen. So optimism still reigns about the reopening of the economy. Things will get back on track. So let's go into some of the risk classes we tend to find. This can be allocations in your 401k plan. You can literally kind of match them up. We prefer large caps in the US. What you're going to have here is asset classes, and you're going to also see these little letters on here. If you don't know what those are ticker symbols for ETFs, which are basically following the indices. So we're on for US. There's TINA. There is no alternative. Equities are the place to be. The bigger companies are more secure. They have better cash flow. The thing to keep in mind is the S&P itself is about 25 to 27% in tech. So therefore, it's heavily weighted to technology, which has been really the outperformer this year. So be aware of that, and we could talk more about what that means later when it comes to sectors. But small caps, we think small caps are just turning back up, and we need small caps to perform. Because once the small caps perform, these generally are the leaders out of market contraction. We're still sticking with growth stocks over value stocks. This really low rate or zero rate investment environment we're in from interest rate standpoint basically puts a higher premium on growth stocks. And we think that it is still their day to run. Value stocks will probably be back at some point. So we're watching that literally every week, and there just hasn't been enough emphasis in the market to favor value stocks. One of the main value stocks types anyway are dividend stocks. And we're risk off here. Dividend cuts have been coming, and there could be more. And we still prefer the growth over value. A lot of the div stocks are value stocks. So not yet, guys. In terms of other places, we'll look at the IFA, which is the international marketplace, developed markets primarily. It's kind of mixed. The dollar decreased in value over the last 4 to 6 weeks, and that's actually helped international stocks. Emerging markets, we like emerging markets. We think these still are the growth engine. Long bonds, these are long dated bonds, generally all-time highs because the job numbers, we're still risk on with long-term bonds here. We're probably getting toward the end of that one, so keep an eye on that one. Junk debt, high yield, things like that. We're risk on, and there's one reason: it's the Fed's behind this thing. So when you have the Fed behind a market, generally you don't fight the Fed. So that makes it a lot easier decision to make. However, there are a bunch of fundamental financial risks within junk bonds, and there could be issues in terms of them being able to pay back the debt. There was a huge mountain of corporate debt that's been created in the last 7 to 8 years, and maybe this is coming home to roost. So still risk on. Emerging market debt, we are risk on. This is for the same reason we like the growth opportunity, but dollar weakness has definitely helped these as well. But if you're looking for yield, this is one of the few places to actually go get it. Lumber, I love lumber because it tells me a lot about what's going on. It's a great indicator. 10-year treasuries, we're kind of risk off on these because you're just not getting paid for holding them. So US dollar, we're kind of risk off on the dollar right now, but dollar could be swinging basically back toward the positive. It's not necessarily bad or good, just realize where it is. Gold got overheated pretty quick, so did silver. We still think there's opportunity because we know that inflation has got to be coming. That's just an overview just quickly in terms of how we view allocating assets just generally in a portfolio. Hopefully this has helped you. And if you have any questions regarding this or anything else in your portfolio or in financial planning in general, please feel free to reach out, contact us on any of those social media sites. So Jim Hiles signing off for now, and we'll talk to you in a month.